Hi, I'm Sam Scheitler from Clark Mortgages. I'm a mortgage broker specialising in the more complex cases. And I wanted to talk about how to improve your mortgage approval odds. So when you're buying a house, there's ultimately so many different things that you're going to have to look at, but the mortgage and how you're going to finance it is primarily where you're going to start. And there's so many different factors in it that it may be a little bit overwhelming. And you may decide you want to do it yourself. You may want a mortgage broker. As someone who deals in the more complex side of things, I'd like to think that I can offer a bit of a broader perspective of how you can deal with improving your odds of getting the mortgage. Firstly, it's income and affordability. Mortgages are a regulated product when you're buying a property to be your home. We've got to understand, can you afford it? And the lender has to be able to justify it. As we've moved on with the times, that affordability is becoming a little bit more flexible, particularly for first-time buyers. So you can make use of longer fixed terms, but there's still a basis of income to affordability. Is the mortgage going to accommodate too much of your evidenceable net income? And what's the loan to income that we can expect? So there are two sides to affordability. You've got an income multiple. So how many times your income can you borrow? And then how much of it will occupy that net income that we're dealing with. On top of that, you've got to understand your credit score. Ultimately, a lender is going to look as to whether you're a favourable applicant, regardless of the property, regardless of whether you can afford it. What's your previous history for paying your bills? Are you likely to default on a mortgage? Generally speaking, someone who has good credit history is going to be viewed more favourably than someone who, regularly misses payments. It's not to say that you can't get a mortgage if you have missed payments here and there. The reality is that, life gets in the way. You might forget to pay that bill. You might get a parking ticket and it goes to a CCJ. That does happen. And so there are lenders that look past that, depending on a number of factors. It could be what's the nature of that missed payment. It could be how recently was it? What's the value of it? There isn't just a one size fits all here. But in the broadest perspective of the market, a lender like, for instance, NatWest or Nationwide, which has a very, very high market share, they can afford to be a little bit more discerning on who they accept. It's probably less likely that if that is your credit history that you go to that side of the market. You may end up looking at one of the other lenders available, one of the other banks or building societies who perhaps has a more flexible view on that kind of thing, where it isn't just automated decisions. Speaking about credit scoring in and of itself isn't just formed upon your credit history. Credit score isn't the same for a lender as it is for the credit score that you or I would see when we sign into Experian or any other credit bureau. It's a credit score entirely made by them in respect to your application. There's other factors at play, and I can't speak for them as to exactly what it is, but things like how much deposit are you putting in? A lower size deposit will influence their requirements for credit score, because the risk to them is higher the less equity that they have in a property, in case of repossessions and that kind of thing. The reality is they operate what is called a credit tiering system. And not all lenders do this, but it is true of a good few. At 5%, you have a higher requirement than a 25% deposit, because if there is a blip here and there, they have a larger size of equity in that property. They've got more security there where they can avoid impacting that application. There are a couple of red flags that we talk about. I do see people hyperbolizing things. People talk about, always avoid gambling. And it's not as black and white. Can you gamble? Yes. Should you regularly do it to a large proportion of your income? No. But that's common sense, I would think, as opposed to being the rule just to get the mortgage. Things like payday loans. Lenders will look at those and they'll see them on your file, and in some cases they'll reject them because payday loans can be indicative of poor money management month to month. That's ultimately what a payday loan is for. So you should avoid those, particularly in the last 12 months in a lot of cases. But again, life gets in the way. You may not have been on the same level of income that you did when you got those payday loans. Never say never. You can have payday loans, you can have defaults, you can have CCJs, but just be realistic that is going to influence, because the major banks, the NatWest, the Barclays, the Halifax, the Nationwide, they have such a huge market share that they can afford to cherry pick. They can afford to look at, do we want these few people who may be a slightly higher risk to us? No, because it jeopardizes the funds that we're investing, the funds we're lending out, which ultimately for a bank then jeopardizes shareholders if they have them. So there are red flags, definitely. Overdraft, avoid being in it, avoid using payday loans, avoid using gambling too much. Don't pay out thousands and thousands of pounds each month on holiday to the deficit of your livelihood. The only thing here is that the way you act now is the only evidence a lender has to the way you're going to act in the future. So if you've got all of these, what we would perhaps say are higher risk spending activities, attitudes to spending, then perhaps that's going to inform what happens after you get a mortgage. So the lender only has that to go off. There are silly little things like, the bank statement references saying drugs, that kind of thing. People talk about it always in their top 5, always make sure that doesn't happen. People are going to have a joke. There is circumstance where people have had fraud flags thrown up because of issues like that. So just be sensible, I suppose, is the underlying issue. Look at yourself objectively, look at your spending habits, look at everything and think, well, would I lend myself that money in the position I'm in today? And really, that's all we as a broker are going to do to justify ourselves and yourself to the lender. That's why time is your ally in these things. The longer ago these issues were, the more we can justify a redemption story, if you will. The fact that happened then, this is where you are now. And then we have a little bit of a chicken and the egg situation with respect to, do you find the property or do you get the agreement in principle? And as a broker, ultimately I start getting paid when I get clients on the board. So I think it's probably a little bit of a biased choice, but I do genuinely believe you should get the agreement in principle. The current market we're in sees properties come and go. There's a whole bunch of work that needs to be done to get an agreement in principle. It's actually a lot quicker to get an agreement in principle a lot of the time direct through a bank yourself. I will say that. The thing is, you can't really rely on that because the amount of people I've seen get an agreement in principle through the bank themselves, which is a non-advised process a lot of the time with the bank, which means that they've had to interpret their income themselves. They've had to interpret their spending and commitments and so on and so forth and declare that to the lender, and they get an agreement in principle. But regardless of where you go, if you're confident in doing that, and I do believe that a lot of the time people who are in long-term employment, very stable jobs, are borrowing a relatively small portion compared to their income, you can be well served by the bank directly. There's something to be said about the services of a broker. Fee-free brokers, for instance, will be able to benefit you because they'll keep track of interest rates the whole way till completion. They take the stress out of putting the application and they make sure you're protected the whole way through, or they might command a small fee to do it. I get involved primarily where there are underlying issues, or perhaps it's just not straightforward, self-employed people, contractors, credit issues, so on and so forth. Whichever way you choose, if you get an agreement in principle and you've got it there, you go and view a property, you like it, you put your offer in, and that's then accepted. You're not waiting then to backtrack to find that you can afford it. In the meantime, someone swoops in and puts an offer in while you're dealing with getting your ducks in order. So I would say get your proof of funding sorted before you go to find that house that you really want to view, because otherwise, if it is a really popular house, I've seen it time and time again, people lose it and that's it. You know, they start looking again for the next 2 months. I suppose the long and short of it is there are ways to improve your odds of approval, and there are attitudes you can take. Increase your deposit, make sure you're borrowing what you can afford, make sure your credit history checks out, avoid making silly mistakes with missing payments and you know, spending too long in your overdraft. But the reality is, if you do those things and you want to buy a house and you can afford it, there is going to be a lender for you. So don't look too much into these big flashing red signs of declined and you can't get a mortgage. If you speak to a bank and they tell you you can't get a mortgage, that doesn't mean universally. It means relative to their criteria. So speak to a broker and find out more.